Qatar is not a nation, but if we were a nation, we would be the 18th largest nation holding US treasuries. We have more treasuries than Germany, UAE, Spain, Australia.
February 23rd, 2021. New York Attorney General Letitia James stepped up to a podium and said 6 words that, in any normal financial system, should have ended a company. Tether's claims were fully backed by US dollars at all times was a lie. It was direct, it was unambiguous, and it came from one of the most powerful legal offices in the United States. For most financial institutions, that statement alone would have triggered collapse, investor panic, regulatory shutdown, reputational death. But that's not what happened, because that was 4 years ago. Today, over $193 billion worth of Tether tokens are circulating through the global economy, more than the GDP of Qatar, more than Hungary, roughly the size of an entire sovereign nation. And despite everything, it has still never undergone a full independent audit. So the real question isn't what Tether is, it's how did it survive that moment and grow even bigger? Here's what Tether wants you to believe. USDT is just a digital dollar. You deposit $1, you receive 1 USDT. Simple, stable, safe, a perfect bridge between traditional finance and crypto. In fact, it's become something even more critical than that. It's the liquidity layer of crypto itself. Over 70% of Bitcoin trades happen in USDT, not actual dollars, which means most of the crypto market doesn't run on fiat money. It runs on Tether. But underneath that simplicity, there's something far stranger, because legally, officially, the headquarters of this system is located at Jailer Place, Tortola, in the British Virgin Islands, a corporate registration address used by thousands of offshore entities. When journalists went looking for the company behind $193 billion, they found nothing. No trading floor, no visible operation, no financial headquarters, just a mailbox. And yet, that mailbox sits at the center of a multi-trillion-dollar financial ecosystem. And behind that system, there isn't a massive bank, there isn't a public company, there isn't a boardroom full of executives. Instead, it's controlled by a small, tightly connected group of individuals. At the center is Giancarlo Devasini, a former plastic surgeon turned financial operator. No public persona, no interviews, almost no visibility. Yet he is widely believed to control a significant share of one of the most important financial entities in crypto. Alongside him, the same group controls Bitfinex, one of the largest cryptocurrency exchanges, which creates a structure that is almost unheard of in traditional finance. They don't just issue the currency, they operate the system where that currency is traded. It's like printing money and owning the market where it circulates, and that's where the story begins to shift. To understand how we got here, you have to go back to 2014. Crypto existed, but it was inefficient. Buying Bitcoin meant wiring real money, waiting days, dealing with unreliable exchanges, and exiting a trade meant leaving the entire ecosystem. Then came Tether. Its idea was almost embarrassingly simple: a digital receipt. You give them $1, you receive 1 token. That token represents that dollar. Always redeemable, always stable. The original white paper even defined a solvency equation. Total tokens in circulation must always equal total dollars held in reserve. It was clean, transparent, elegant, and for early crypto, it worked. Tether became the plumbing of the entire system. But in 2019, something changed. Quietly, without headlines, without user awareness, Tether updated its terms. Before, every token was backed 1-to-1 by currency. After, tokens were backed by reserves that could include cash equivalents, loans, other investments, even receivables from affiliated entities. That one change, subtle on paper, completely transformed the system, because now Tether wasn't just holding money, it was managing assets, allocating capital, extending credit. It stopped being a simple digital dollar and became something much closer to an offshore shadow bank, and almost nobody noticed. While that shift happened quietly, the the system itself exploded from millions to billions to $193 billion in circulation. At the same time, Tether accumulated over $140 billion in US treasuries, making it one of the largest holders of US government debt in the world. Not a bank, not a country, a crypto company. And in 2025 alone, it generated over $10 billion in profit with fewer than 100 employees. Which raises a serious question. What kind of system generates that level of profit with that level of opacity? Now, this is where things get controversial. In 2020, a widely cited academic paper analyzed Tether flows across the blockchain. What it found was unusual. Large amounts of USDT tended to enter the market right after Bitcoin price drops and were often followed by price recoveries. The implication wasn't proven, but it was powerful. Tether might not just be responding to demand, it might be influencing it. A loop, print to inject liquidity to buy assets, to prices rise to justify issuance, a self-reinforcing system, a financial Ouroboros, a snake feeding on itself. Tether denies this completely, but the pattern remains one of the most debated topics in crypto finance. And when systems get this opaque, you're no longer in control. That's why tools like The Alchemist exist, an automated trading system for MetaTrader 4 that runs 24/7, but keeps you in control of your broker, capital, and risk. No hidden custody. Use code Tether 10 for 10% off, link below, because when control disappears, that's when things start to break. Then came the investigation. In 2021, the New York Attorney General found that Tether was not fully backed at all times. At one point, over $700 million was taken from Tether's reserves to cover losses at Bitfinex, money that was supposed to back user funds. Publicly, Tether maintained everything was stable, but internally, the reserves had already been stretched. The case ended with an $18.5 million settlement. No admission of wrongdoing, no shutdown, and no real slowdown in growth. At the same time, Tether was expanding beyond exchanges. It became the backbone of a parallel financial system, a global network of cash desks, broker networks, off-exchange conversions, allowing users to move between USDT and physical cash without touching banks. Billions flow through these channels, fast, borderless, and difficult to track. In one case, over $1.4 billion in USDT was traced through a single wallet linked to illicit activity. This isn't just a currency anymore, it's infrastructure, and infrastructure doesn't fail quietly. Now here's the number that matters most. Tether reports about $6.3 billion in excess reserves. That's just 3.3% of its total liabilities, which means a 4% drop in asset value would wipe out that buffer entirely. At that point, Tether becomes technically insolvent. Not theoretically, mathematically. Now imagine how that unfolds. Crypto markets fall, Bitcoin drops sharply, confidence starts to break, investors rush to redeem USDT, billions try to exit at once. At the same time, loans backing Tether's reserves begin to fail. Now Tether needs liquidity, fast. To meet redemptions, it begins selling assets, including tens of billions in US treasuries. And suddenly, this isn't just a crypto problem. Bond yields spike, liquidity tightens, global markets react, because Tether isn't isolated, it's deeply connected. And now, the system is finally being challenged. In 2025, the US passed the Genius Act, the first major federal framework for stablecoins. It requires one-to-one backing with high-quality assets, monthly reserve disclosures, full independent audits. Deadline, July 2026. For the first time, Tether must prove its reserves, not through statements or snapshots, but through full financial transparency. Tether might survive this, the audit might pass, the system might be stronger than critics believe. But here is the question the audit cannot answer. Why did it take 10 years and a federal law to make it happen? a company managing $193 billion in assets, more than the GDP of most countries, more than the treasury holdings of Saudi Arabia, has been run since 2014 out of a corporate mailbox in the British Virgin Islands by a handful of people whose names most of the world has never heard, promising that the money was always there, backed one-to-one, just like the white paper said. The NYAG said that was a lie. The CFTC said it was a lie. The audit is coming. And in the meantime, every trade you've ever made in crypto passed through it.